Hey everyone, thank you for coming to my live stream. We'll talk about all housing market and economics. A good amount of news in the last week. I'm going to be talking about new housing data that Redfin just released this morning. I'll be talking about inflation data, last week's jobs report, what's in store for the Fed as Kevin Warsh takes the position of Fed chair, and also some other interesting stories that I'm seeing from around different sources about what is happening in the economy and the housing market. But let's just get right into it. I'm going to share my screen so that you all can see what I'm looking at. Make this look nice. Okay, so first up is from Redfin News. We release weekly housing market data every single Thursday. That's why I schedule these live streams for Thursdays so that I can talk about them when they are fresh. And the headline today is that record home prices and high mortgage rates are pushing down pending sales. Basically, housing is still really unaffordable, right? Newsflash, buying a home is unaffordable. And that is starting to weigh on demand for home buying. Has it been a couple of weeks? Yeah, a couple of weeks ago, President Trump and his team went to China to try to negotiate a reopening of the Strait of Hormuz. It seemed like that was a moment where things could start possibly getting better in the global economy, where mortgage rates potentially could have come down had a deal been struck. But a deal was not struck. A couple weeks later, there's still no deal. And because mortgage rates remain high, it's starting to weigh on buyers. Earlier in the year, around April and May, we started to see an uptick in the number of buyers out there looking for homes, making offers on homes. But since mortgage rates started to go back up and have remained high, that demand has weakened. And that's what this report is really highlighting. So, pending home sales, that's homes that have received and accepted an offer from a buyer. Those pending home sales are down 0.6% from a week earlier, and this is the fourth straight week of declines. And these 4 weeks of declines, it really started with that trip to China that did not result in a deal. And, every week goes on, we're not getting a deal about the Strait of Hormuz reopening. All of the cheap talk about the strait's going to be open any day now. It's going to be open any week, any month. It's just falling on deaf ears because, it's like the boy who cried wolf. We've heard it so many times. So now mortgage rates are up and they're stuck. It's a Cardi B quote. They're up and they're stuck. And buyers are backing off. But it's not just mortgage rates. It's also just the general economic uncertainty that is driving prospective buyers away. People are jittery about the war, about inflation, and rates could go even higher because of what we're seeing in the economic data. So just put things in perspective, I'm going to scroll down to where we can see some charts. Median sale prices record highs. Usually prices like peak around late June, early July, but we've surpassed the highest point for home prices last year already, with the median home price now being $400,894. Highest it's ever been. But I mean, that's kind of normal. If prices go up every year, of course, we're going to hit a new record every year. But I mean, prices aren't really supposed to go up every year. Historically, it's been normal to have some years where prices actually go down. But prices only being up 1.5%, it means they're down in real terms because inflation is at around 3%. So in real terms, home prices are lower. In nominal terms, that's not inflation adjusted, they've reached a record high. But what's interesting is that, if you're getting a mortgage to buy a home, it is actually more affordable to get a mortgage on a median priced home this year than it would have been last year. Even though prices are higher now, mortgage rates are actually lower. And I just talked about how mortgage rates are high. Mortgage rates were coming down second half of 2025, coming down in the first couple of months of 2026, and they went back up because of the war in Iran. But even though they've gone back up, they're still lower than they were last year, which means that buying a home this June is more affordable than it would have been last June, but really not by much, only down 1.6%. The blue line is where it was in 2025. And you can see how it started to get more affordable in the second half of 2025 as mortgage rates came down. And then it started off this year a little bit more affordable, but then it came back up because mortgage rates went up because of the conflict in Iran, and they've remained up. And pretty soon, if this trajectory continues, we're going to be in the opposite situation where mortgage payments are higher come August of 2026 than they were in August of 2025. So, I mean, we're really just talking about like 1 or 2 percentage point differences, but I think this pretty much explains why demand remains so weak, and it's been so weak since mortgage rates went up, and it's really just mortgage rates. It's like the simplest explanation. Here's pending sales. You can see that they're like up a little tiny bit, but not very much. All right, what else is in the news? So I talked about what's happening more nationally. This report is more about from Redfin News that just came out 2 days ago, is about like what's happening more at a local level. Where are we seeing the strongest buyers markets versus sellers markets as measured by how many buyers are looking versus how many sellers are willing to sell? And I think the interesting takeaway here is that Nashville, Miami, and Austin, these used to be really strong sellers markets where buyers were just flooding in during the pandemic to buy any home that they could get. Dozens of offers on homes selling for hundreds of thousands of dollars over asking price in these super hot markets. But you know, the bigger they are, the harder they fall. Is that the expression? These markets have definitely had a big fall from being some of the hottest markets. Nationally, there are 47% more sellers than there are buyers out there. I will caveat that though, because these sellers are not very serious sellers. They're delisting their homes, they're delisting and relisting. They're expecting prices that are too high, and buyers and sellers just can't see eye to eye in this market. Sellers still have their record low mortgage payments they got during the pandemic. They don't want to give them up unless they can get enough money to buy their next home with a good chunk of cash so that they don't have to take on as much debt. The buyers are in the exact opposite situation. They just see the high mortgage rates and they can't afford to buy a home at such high mortgage rates and such high prices. They want the prices to come down. I mean, this is normal. Sellers want prices to go up, buyers want prices to go down. But usually, like sellers and buyers are a bit more on the same page. It's the fact that sellers are holding on to these record low mortgage rates that allow them to stay in their homes for below what a first time what a new buyer would have to pay to be in that home, and that's causing this illiquidity in the market, this disconnect, this lack of transactions, this thinness in the market. It's all because of really the pandemic. We're still feeling the after effects of the pandemic. You know, 5 years, it's been like 5 years since the vaccine, still affecting the housing market. But yeah, more about this local stuff. So according to Redfin Premier Agent Aaron Glicken in Nashville, Tennessee, listings in Nashville are skyrocketing, but buyers are being picky. Sellers are struggling to wrap their minds around lower prices, like that they need to lower prices. And that's why a lot of listings are sitting on the market and why there are still so many sellers trying to sell. They could sell if they lowered their prices, but they don't want to lower their prices, so they just stay on the market. And like I said, buyers are being very particular. Aaron agrees. They are contending with higher mortgage rates. They have more to choose from. Maybe that causes a little bit of choice paralysis. And they only want to close a deal with a seller who is willing to negotiate. So my advice, if you're trying to sell your home, like be for real. Are you really trying to sell? If you're really trying to sell, come in with a price that will signal to buyers that you are willing to meet them where they're at. Putting your market just to watch it sit and then have price, it's not fun for your family, not fun for your, it's their expectations. And some sellers are using this like exclusive listing strategy where they only market their homes to buyers that are in their brokerage so that they can kind of test the market before they go wide. And if that helps sellers get into the right headspace for when they do go wide, I think that's a useful thing. Anything to get these sellers kind of back to reality about where the buyers are at. So I see we have a couple people watching. If you want to leave a question, feel free to do so. I'm happy to answer questions as they come. That's what's happening in the housing market. Other big news, we got some inflation data this week. Headline CPI, that's what our measure of consumer prices, increased 0.5% in May, which isn't, the best news, but it's also what people were expecting. So it didn't really move markets much. And this is the first time we've gone over 4% annual inflation since May 2023. The target inflation rate that the Fed tries to set is 2%. So being at 4%, even though this is all in and it has like all this noisy stuff in it, it's really not good. It's not good for the Fed's reputation. And it's going to make it pretty impossible for the Fed to cut rates because there's just no economic data out there to justify why they should cut rates. So we're saying the Fed will almost certainly hold rates steady. And, last time there was this inflation back in 2022 when the pandemic was ending and the global economy was turning back on, and there were all these pains of of global supply chains that made it hard to get things where they needed to go. We also saw inflation. The Fed tried to see through it, thinking that it was temporary. It wasn't temporary, and this time around, they're not going to have the credibility to just say this inflation is temporary. It's just caused by the war. They're going to have to actually deal with it and explain themselves why they're not hiking rates. Definitely can't justify cutting rates. All right, John Lane, we're on YouTube. Coast metros like San Francisco or San Jose or Los Angeles, San Diego, Seattle. Portland is maybe the most affordable big metro that right in the ocean, but I'm going to call it West Coast Portland. Uh, okay, I'm going to end Instagram. Okay, sorry, Instagram. You got cut off. You got kicked off the island. Hopefully, the audio is better. Let me know if it is. Okay, but back to Portland. I can actually bring up Portland's housing market data right here. Let me go to the data center. Redfin's data center. Free for anybody to use. Let me go hop over on to me. Let me look at just this data. Let me see Portland. Okay. Portland, they've had 8% increase in pending sales. And that's happened without much of an increase in prices. Prices have been pretty flat, which is kind of puzzling. But if you compare that to like Seattle has had a 7% decline in sales and a 1 percentage point decline in prices. So Portland is doing better. And I think you asked about, I don't think I can get condos in this. Okay, so John Lane says there's a lot of condos for sale in Portland. That would explain why there are so many sales happening, yet prices have declined, because the market is shifting more towards that more affordable segment of the market. Condos cost less than single family homes. So that's probably why we're seeing more sales without there being an increase in prices. But active listings are down, which indicates that like these condos are moving. They're not sitting on the market, because then you would see um, that inventory start to get stale. So there seems to be a good amount of demand in Portland, a good amount of supply, especially supply at the cheaper end, which is facilitating more sales without median prices going up. And that sounds like a good thing. I'm confused. Jill Lane, are you worried about Portland? It seems like it's good that we're getting more sales without an increase in prices. So yeah, that's my take on it. Portland seems like it's doing better than these other coastal metros that are either dealing with too much demand and prices going up, or not enough demand and prices going down. Portland seems to be in this sweet spot where they're also adding affordable inventory. Cool. All right, what else would I want to talk about? Oh, back to the Fed. Always talking about the Fed. So we're going to have a new Fed chair, Kevin Warsh, who was appointed by President Donald Trump to be the new Fed chair. President Trump was very critical of our former Fed chair, Jerome Powell, for not lowering interest rates. President Trump has said many times that he wants housing to become more affordable, and he thinks the way to do that is to get mortgage rates down. He even directed the director of the FHA to buy a bunch of mortgage-backed securities. These are bundled mortgages all smushed together. He bought them. That adds liquidity to the mortgage market. It brought mortgage rates down a little bit. But then we went to war. And because we went to war, gas prices are up, inflation is back up. And it really leaves the Fed in this predicament where they really can't lower interest rates. There's no justifiable reason to lower interest rates right now. We got a jobs report last week that was pretty strong. Inflation data is still coming in hot, not like inconceivably hot, kind of in line with expectations, but still hot. And that really gives the Fed no option except to keep interest rates high. And I'm sure there's going to be some people on the Fed saying that we need to hike interest rates. So Kevin Warsh is just one out of 13 voting members on the Federal Reserve Board. And it's going to be really hard for him to justify doing anything but keeping rates the same. What I am very interested, though, is what his comments are going to be at that Fed meeting. What is he going to say to all of the journalists during that press briefing? Warsh has stated that he doesn't want to give much forward guidance. He thinks that the Fed has been giving too much forward guidance on where rates are going to go with those little dot plots that show where they think they're going to be setting interest rates in the future. He said he doesn't want to do that, or doesn't want to do much of that. So does that mean we're going to have a super short Fed briefing where he just doesn't really say much at all? The risk in doing that is that not saying anything leaves a vacuum for the markets to interpret things however they wish. And when markets are interpreting things instead of getting guidance from the Fed, the markets could go in any direction in terms of their interpretations, and that could lead to more volatility in the stock market. And volatility is bad for mortgage rates. So by saying nothing, you kind of open the door for more volatility, which could lead to higher mortgage rates. So I think that's like what I'm paying attention to the most, is just when I think it's a foregone conclusion that they're going to keep rates the same. But what does he say? Does he say anything? Does he say nothing? And then how do the markets react based on what he does or doesn't say? So that's coming next week. All right, John Lane says the audio is back. Great. Sorry, Instagram, you got booted because you were taking up too much bandwidth. But we still got YouTube, LinkedIn, TikTok, Substack here. So keep it going. All right. John Lane says we have 8 condos for sale. Nothing has moved in 6 months since Christmas. I wonder what's happening with those condos. So one thing that's been happening in the condo market is that HOA fees are going up. A lot of condos are old and they have deferred maintenance. I think we did a report about this. Let me see if I can find this. It might be kind of old, but probably still relevant. Okay, so this one is about, this report is as of October, but it's probably the same story or similar story, just maybe more exacerbated because of high mortgage rates. Back in October, there were 72% more condo sellers than buyers in the US. And that other chart I showed you, let me see, it's over here. You can see how there were 47% more sellers of homes just in general than buyers, and that's been pretty flat all year, so I assume for condos it's the same. For condos, though, 72% more condo sellers than buyers. So we have a lot of condos out there in the market, way more condo sellers than there are condo buyers. And part of the reason why there are both more people trying to sell their condos and not much interest in buying these condos is because HOA fees are going up. HOA fees are homeowners association fees. And when you live in a condo, you pay into the HOA, and the HOA takes that money and pays for things like maintenance for the exterior of the building, like the roof. They might, if there's a pool, it goes into maintaining the pool, it goes into maintaining landscaping. It might pay for lawyers, or hopefully not too many lawyers, a lawyer to kind of manage the legal documents. It might pay for assessors to come in and look at the condo to determine what work needs to be done. But in general, when you're in a condo, like, you maintain your little unit, but you have to pay HOA fees to maintain the building as a whole. And the political economy of these condo boards is that nobody ever wants to vote to increase their own cost. So for a long time, a lot of these condos have been deferring maintenance. Owners of these condos have been kicking the can down the road on things, on big expenses, but it's starting to come to a head, and these condos are needing to do repairs. You know, storms can exacerbate that. When you have a leak in your roof, you can't really ignore the problem anymore. There was a Surfside condo collapse in Florida that happened a couple of years ago, where a lot of people died because of deferred maintenance on a condo. So, and also just cost of living in general has gone up. It's going to cost more to employ the landscapers, to employ the pool maintainer, to employ the lawyer. All of that, all those costs have gone up since the pandemic because inflation has increased. And I think a lot of people think the benefit of buying a home is that you don't have to worry about your housing costs going up anymore. But that's not completely true. You don't have to worry about your mortgage payment going up if you have a fixed rate mortgage, but you still have to worry about your HOA fees going up. And even if you don't have an HOA fee, you have to worry about your insurance costs, your maintenance costs. HOA fees encapsulate some of those insurance and maintenance costs. Like, the HOA will be paying for the insurance for the whole building, and those are going up too. So sometimes that shows up in the HOA fee, instead of in like your direct insurance costs. But all this to say is that the cost of owning a condo apart from the mortgage has increased, and this hits both owners and buyers. Owners who maybe are in a fixed income, maybe they're older people, they may not have the money to pay for these higher HOA fees, and then they have to sell. So that increases the supply of condos on the market. But you also have buyers not wanting to pay these HOA fees either. So that reduces demand, increases supply at the same time, and they get the situation when there are 72% more condo sellers than buyers. Now, another part of this is a bit rosier, a bit better of a take, is that we've had a lot of new construction of condos. A lot of new condos were built during the pandemic when interest rates were low, and that new supply is part of the story of why supply has gone up. But a lot of those new construction builds, they tend to sell quicker because they don't have these high HOA fees. There is no deferred maintenance on new construction, but it makes it even harder for these older buildings, which have these high HOA fees, to compete against the new construction, and it makes it harder for those existing condo owners to sell. And then you can have homes sitting on the market for a long time, especially if that owner is not super motivated, if they don't have a high mortgage payment and they're living in the home while they're trying to sell it. They might just take a really long time to sell, and that's why the condo market is even more out of balance than the for sale market. Cool. All right, what else are we talking about today? Oh yeah, global economy. So the World Bank has cut their global growth outlook to 2.5% and warns of a drop to 1.3% if war fallout spreads to markets. So the United States is like somewhat insulated from what's happening in the Strait of Hormuz because we don't get our oil directly from the Strait of Hormuz. We get it from domestic sources, we get it from other international sources. But the global economy, there's like reasons to be worried about that. If the global economy slows down, we could get a decline in mortgage rates. So something you asked about, let me pause for a second and give you that condo report that somebody asked for. All right, here's the condo report. It looks like it went to YouTube and LinkedIn. All right, back to the global economy. So the global economy is slowing down. At least that's what the World Bank seems to think. I know some economists that work for the World Bank. They're smart. They know what they're talking about. If they say that this is happening, I believe. But this is interesting. Like, okay, why am I talking about the global economy, even though my focus is the U.S. housing market? If the global economy slows down, or if the global economy, even worse, enters into a recession, mortgage rates will come down. It could take down the US economy as well, because the US economy is interconnected to the global economy. But even, like, let's assume that the US economy is doing just fine. The US economy is being propelled by SpaceX going public and OpenAI and the gambling economy. These seem to be the biggest sectors in the US economy right now that are growing. But the global economy is in decline. That would send mortgage rates down, and it would actually loosen up the housing market. We would have more people being able to afford to buy a home in the United States, and more people willing to sell a home because they would be able to get a slightly better price. And when they go to buy their next home, they will be able to buy their next home at a better price. So this is just interesting. I mean, like, with the Strait of Hormuz being closed, there's a timeline of how this will play out. For a time, it's going to cause higher inflation. But if it goes on for too long, eventually, because prices are higher all around the world, consumption all around the world will drop. And when consumption all around the world will drop, like, people aren't buying as much stuff because stuff is too expensive, then we start getting declines in the global economy, potentially a recession. And it really just depends on how long this all goes on. If things reopen, then we don't get to that next phase of global recession. But if we do, then mortgage rates will start coming down again. I'm not saying this is what I want. I'm not wishing for a global recession. That is the last thing I want. But, for people in the housing market who study the housing market, you usually think about what this means for housing affordability and mortgage rates. And it would make mortgage rates cheaper, make buying a home cheaper. Okay, Jawanza over on LinkedIn asks, the way the housing market is set up at the moment, would you say it is more reasonable to rent an apartment? In almost every city in the United States, it is going to be more affordable on a monthly basis to rent a one-bedroom apartment than it will be to own a one-bedroom condo. This is part of the reason why it's so hard to sell a condo right now, because condos versus apartments, that's very apples to apples comparison. You could get like the exact same thing, and really all you're deciding is, do I want to rent this unit or do I want to buy this unit? And it is very obvious right now that it's cheaper to rent, but it will not stay that way forever. When the cost of renting and the cost of ownership are out of whack, over time they tend to get closer and closer together, because the people who are choosing to rent instead of buy, they add demand to the rental market. That pushes up rents. And when there's not enough people buying these condos, eventually these condo prices are going to have to come down. And over time, you get this convergence where the cost of owning versus renting gets closer and closer. Right now, they're very far apart, but the fact that they're so far apart tells you that they're going to start to converge. But it perfectly explains why people don't want to buy condos right now, because they can just rent for cheaper. And, if they just put it off for another year, they can get cheap rent now and possibly still get into the condo market at a point when prices are not elevated. Maybe they're waiting for condo prices to come down a bit more for sellers to get more realistic, or for those HOA fees to not feel so scary. Some of the times with these condos, they do special assessments. Like, instead of raising your HOA fee by $100 every month, they might say every owner has to pay in $1,000 right now. And those special assessments can be really scary to buyers. So I think over time, like, as these HOA fees become normalized, as these special assessments get paid, condo prices come down, we'll see the cost of renting and cost of owning converge, and the cost of renting go up and the cost of owning come back down. But for now, it's just pretty clear that renting is cheaper. And it really does go back to what happened during the pandemic, where for a lot of people who own condos and have owned them since the pandemic, their cost of ownership is still lower than them selling and renting, because they have those cheap mortgages. But it's starting to converge. All right. What else is there to talk about? I talked about the global economy being slow. I saw the story from CBS News I thought was really interesting. It says that nearly half of Americans say they're worse off financially than a year ago. Part of the reason why this might be is because of inflation. No, I think that's the big reason. What am I saying? Part of the reason. The reason why this is because of inflation. Inflation is now going up faster than wages are going up. So that makes people literally, less able to afford the things that they want in life. It makes them literally poorer when their wages are not increasing as fast as the cost of everything that they buy is increasing. So that would explain why nearly half of Americans say they are worse off financially than a year ago. But this report also notes that about 15% of Americans said they believe they could lose their job within the next year. And that's a half percentage point above the 12-month average. So people are worried about losing their jobs. The job data is starting to look stronger, but all we hear all day, every day in the news is about how AI is going to replace everybody's job. So whether that's hype, whether that's just these AI executives trying to hype up the power of AI before they go public, it still seeps out into people's views of their financial situation. And if you think you're going to get fired in the next 12 months, you're probably not going to want to buy a home, right? So this also explains why the housing market is weak, because people just aren't confident in the economy. The gas prices don't help either. That's a very salient cost that people see all the time. So I get it. I get why people feel like they're worse off. I think the optimism is depleting in the economy. Okay. And then I talked about OpenAI filing to go public. We also have SpaceX, which now has absorbed XAI, like Grok. It's another AI company about to go public. And then we also have Anthropic potentially going public. We did this report about how, let me see, Bay Area. I talked about this last week, but I think it's worth bringing up. We did this report about how Bay Area luxury prices have been just on fire, up 13%. When we talked to our agents in the Bay Area, they said that a lot of this demand for luxury homes is coming from AI money, people getting these ridiculous $500,000 signing bonuses and wanting to put it right into real estate, or people who already work for the publicly traded AI companies like Google, seeing their stock compensation increase and wanting to put that into the housing market. But it also could be a run-up to these big IPOs. So we have the OpenAI about to go public. Here's a story about the Bay Area. There is a San Francisco home being sold with the option of paying in AI stock. It's listed for $2.995 million, but the owner said that they will consider stock from AI company as payments, like pre-IPO stock. So I mean, like maybe this is just an anecdote. It's just one home. One home does not make a trend. But when I saw this, I was like, oh, is that part of the reason why luxury home prices in the Bay Area are already so high? Because people are anticipating that prices are going to go up. If you are anticipating that because OpenAI is going public and because Anthropic is going public, there's going to be a lot of money flowing into the real estate market in the Bay Area, it would behoove you as a savvy real estate investor to get in early. And now is the early moment. You buy before all those companies go public, and then you watch your home go up in value as all of those new multimillionaires try to buy homes in the Bay Area. And so I thought it was super interesting that there is this one person, one homeowner who is kind of like creating a market to allow for this to happen earlier, even ahead of these IPOs. This homeowner is saying, give me your IPO, pre-IPO stock. I'll give you my home. You can get the home earlier. I get the pre-IPO stock that I think is going to go to the moon, as they say. And both sides get to front run the real estate market in the IPO market. So yeah, this is really interesting. I'm going to keep an eye on this. It just makes me think that this trend of Bay Area home prices going up is the beginning of something, not a temporary thing. But we're going to keep watching it. The SpaceX IPO probably won't have that much impact on the Bay Area market in particular because SpaceX is located in Texas. It was previously located in Los Angeles. I know they have offices in Seattle. So the people who become multimillionaires off of the SpaceX IPO probably aren't going to drive up prices in any one particular market. But OpenAI is San Francisco based, Anthropic is San Francisco based, and just the size of these IPOs, it probably and there's not that many homes in San Francisco. It's a very, very tight market, very limited inventory. They do not build like they really should. It's been a problem for over a decade now that San Francisco does not build enough homes. And because you have restricted supply, all the money flows in, it just drives up prices. Existing homeowners are the winners. I mean, you have the people who own this, who work for these companies, who actually like risked their careers on these companies that were just startups at one point. No chance, no like certainty of them actually becoming publicly traded. It was a gamble for them. But because they need a place to live, they hand over a good chunk of their money to the homeowners and landowners in the Bay Area. And those homeowners and landowners who didn't do anything to these companies, they are actually the real winners. And this is here, I'm talking about land values again. So I got to bring up my guy, Henry George, because this is all he talked about, was how because we don't tax land, landowners reap the benefits of our prosperous economy without having to contribute anything in. But all California would have to do is start taxing their land, or really just get rid of Prop 13, which means that taxes don't go up with land values. I'm not going to get in a whole tangent with that right now, but it always comes back to this. It always comes back to land values. Okay. What else is going on? Oh, I wrote something this week. I wrote about Gen Z home buying trends. They have a little AI summary here on Forbes. Thanks, Forbes. You don't have to read my article. You can just read the AI summary. That's fine. Basically, I mean, I'm really interested in what's going to happen with Gen Z. It seems like Gen Z is really bummed out about the economy more so than other generations. They're still spending money, but there was this economics paper that came out from researchers at Northwestern University of Chicago, and they looked at what would happen to a generation if home buying became really unaffordable. And their model predicted that the generation would spend more money on consumption, like not assets, investments, but on consumption, put less effort into their careers, into increasing their earnings, and engage in riskier behaviors. And they went and took this model and tested it with data, and the data confirmed what the model predicted. But like just what you hear about with Gen Z, it seems like that confirms like just all the stuff we hear about Gen Z doing these meme stocks, getting into retail trading, retail investing, gambling, prediction markets. Those are all risky behaviors. They're consuming more because we see that in the consumption data that they're not like slowing down their consumption. They're still consuming. They're still buying things. Are they putting less effort into their careers? I that part probably hard to test because it's not easy to find a job out there for an entry-level worker who just graduated from college. So that part I would put it as like, I don't know, uncertain. But it does seem like the lack of home ownership, attainability, is maybe what's contributing to them taking on these riskier behaviors or just getting disillusioned, becoming nihilists. The original title of this was about economic nihilism and like giving up on the economy when the path to the American dream goes away. In the United States, we've always had this conception of the American dream. It like goes back to the founding and property, life, liberty, and property being like what we're supposed to be pursuing in the United States. And when Americans feel like they're not on the track to be able to own their own property, it can make them feel very disillusioned in that whole entire American dream and maybe lead them to do those riskier behaviors, riskier investments, live for the day, consume for the day, save less, invest less in their careers. But the silver lining that I think is that I think this is temporary. Home affordability, as I said, improved this year. I guess it might not improve the second half of this year. But home affordability is probably going to improve over the next decade because of demographic shifts. Baby boomers are getting older. They're going to be dying. I don't know how I'll say it. I always try to think of like a sensitive way to just say that, hey, all these baby boomers are going to die and then their homes are going to be up for sale. I don't know if there's a good way to say that. But when baby boomers pass on, there will be more homes available for sale for Gen Z to buy. they're probably not going to be move-in ready. They're probably going to need some work. And in very high land value areas, again, back on land values, we will probably see a lot of single family homes previously owned by boomers with all this deferred maintenance just get torn down, tear downs all over LA. That's what I see when I drive around LA, is a lot of tear downs, because they're just old homes that were not built for a changing climate, that have not necessarily been well maintained, and they're sitting on extremely valuable land. In LA, 99% of property of homes for sale in LA are unaffordable to somebody making the local median income. There's like the biggest disconnect between the price of homes and the incomes that people make in LA. So I think when these baby boomers pass on, LA is probably the place where I'd expect to see the most densification. They got the subway going there now. They're investing in the subway. So subway combined with densification, I think that it's going to become a much more livable city over the next 20 years. It's a long time, but that's the timeline that Gen Z is operating on. 20 years from now, they'll probably be able to much more easily afford a home in a urban environment with access to public transit. And that's not just LA. LA, I think, is the most extreme example. But that seems to be the direction that we're moving in. Oh, wait, this reminds me of a different story. Hey, I led into my next story that I want to talk about. The US is building more housing near transit, but not nearly enough. We are already on this path towards densification, towards urbanization, better public transit, people being less reliant on cars. That's good news. There's still a lot of work to be done, but this is like the long-term trend that I see in housing. There were some good stats in here. All right. In 2022, 45% of all homes were located within a half mile of a bus or transit stop, amounting to 67 million housing units. And that's 36% growth in the last 2 decades. So we are headed in the right direction. We are increasingly building housing near transit. Now, does the bus come on time? I don't know. Is the bus stuck in traffic? Perhaps. So this doesn't necessarily mean that like this housing is really in a bus rider's paradise or anything, but it's encouraging to see that we're moving in the right direction. The Yes in My Backyard movement and pro-housing movements have been winning. The YIMBYs are winning. We need to keep winning, but the YIMBYs have been winning. And that's good news. Some good news for you, that housing will get more affordable over time. Gen Z, they may be despairing right now, but give them a decade or two and they will probably be better off, maybe even better off than millennials were in terms of their housing options. Millennials have had a rough go with the foreclosure crisis, and then with housing affordability getting nutso during the pandemic and after the pandemic with mortgage rates remaining high. But yeah, you never know what could happen. The future will probably be different, not necessarily better or worse, just very different. But at least it'll get better, I think, in this dimension of having more dense housing near transit so you don't have to rely on your car. And that's good for the environment. And it's good for you because you don't have to pay money for gasoline and insurance. Cars are very expensive. All right, what was the last story? Oh yeah, this is the last story that I want to talk about. Ken Griffin supercharges his Miami bet after Mamdani tax fight. So there has been this trend, really, I think starting during the pandemic, of billionaires moving to Miami because Miami has very favorable business environment, tax environment for these billionaires. And this is like always so perplexing to me because like, I mean, I think we assume that the billionaires have the smart money, as they say in the market, that they're the ones who have the most information and therefore they're the ones making the most rational decisions. And if you think that billionaires are spending their money rationally, it's a bit perplexing that somebody like Ken Griffin and all these other billionaires, Elon Musk, I think Pierre Thiel, even Mark Zuckerberg, Bezos, they're all putting their money into Florida. Part of it is that they're just running away from taxes. So I guess it's rational to run away from taxes to a tax haven. But they're investing in real estate. Like Ken Griffin is building a commercial tower in Biscayne Bay, constructing a 300-unit apartment building in what many climate scientists are calling ground zero for sea level rise climate change. So they're putting all this money into what seems like a very risky place from a climate perspective. But there are a couple things that could explain this. One is that they're billionaires, and if they lose money because their real estate investments go down in value in just one market, they got investments all over the world. So what is it to them? It's just a drop in the bucket. They're just operating with a different relationship to money. When I see, a 300 unit apartment building and a multi-billion dollar commercial tower, I think, whoa, that's a lot of money. But to Ken Griffin, maybe it's just like, a percentage noise. It's volatility in his stock portfolio. It doesn't really matter. Another explanation is that all of these billionaires are intending to protect their real estate investments. They're going to be investing in local infrastructure, seawalls, drainage systems, cutting edge building practices, so that their buildings can withstand climate change. That doesn't mean that all of Miami or all of Florida is safe. We could have this future version of Miami where they're like these islands of extremely valuable real estate, and everywhere else is like literally underwater. But I think it's just super interesting that that there's all these billionaires seem to have no problem, no qualms about investing in the most climate risky real estate market in the entire country. So yeah. Okay, I made it through everything I wanted to talk about today. See if I have any questions. Okay, I have some questions over on TikTok. Let's see. Someone said, oh, do you ever talk to Diva Sunglasses? We are mutuals on TikTok. Shout out to Diva Sunglasses. Let's see. Someone said, how do we stop NIMBYism? I don't think you can stop like NIMBYism. There will always be NIMBYs. NIMBYism is like the political manifestation of myopia, being short-sighted, and being selfish. It's like a mindset where all you can think about is yourself and you can't think about the future. Maybe it belongs in the DSM or something, I don't know. But you can't like stop NIMBYism any more than you can stop, I don't know, any other compulsion, any other mental state. It's going to be there. It's always going to be there. There's always going to be NIMBYs. What we can do as YIMBYs is just be more effective than them. NIMBYs are naturally good at organizing because it's easy to rally people around a negative emotion. And it's people can connect with one another on a negative emotion and provide like mental support to one another. If you go on Nextdoor, you'll see a bunch of NIMBYs yes-anding each other about how terrible the new apartment building is, or how their neighborhood is changing too much, or whatever other NIMBY complaint they may have. It is inherently harder to organize around something positive that is more abstract and about the future the way that YIMBYs do. But I think that the ability for YIMBYs to talk to one another online and engage in arguments and debate and really just use logical arguments is what makes is like their superpower. And if you combine that with YIMBYs actually showing up and talking to policy leaders, going to town meetings at a very local level, like when you're online, you're always thinking about like what's happening nationally online or globally online, but being able to do it at a local level, I think that combined with just logic, being right, like literally just being right, is what will make YIMBYs win. And also political leaders, they care about appeasing their voters, but they also care about their budgets. And if you don't prioritize housing, it can lead to like long-term problems in your budget, because a lot of municipal leaders get more money from property taxes, and the way to increase your property tax base is to create more property. So YIMBYs can connect with policy leaders just on like that basic economics alone. So I think YIMBYs in the long term, I think YIMBYs are winning. I think in the long term they will win, but you're never going to eradicate NIMBYs. You just kind of have to minimize the the powers of persuasion they have over political leaders. If all the political leaders here is just one group of people complaining, they're going to naturally address those complaints. They need people on the other side that are equally activated so that it's more of a balanced discussion. And then when it's a balanced discussion, it becomes more about logic than just about who's shouting the loudest. So that's my take on it. Yes, John Lane, YIMBYs will win the day. I can show this. There are more of us, and we have the data on our side. Are there more of us? I would think that's interesting. Oh, no, there are more of us. We did a survey. Redfin did a survey a while back. And when you ask people how they feel about dense housing going in their neighborhoods, most of them are fine with it. I mean, maybe like they could be scared out of it by the NIMBYs who say like, oh, you're going to build this apartment building. You're going to have a bunch of low income people moving in. There's going to be crime. There's going to be traffic. But without that influence, people naturally are okay with housing. So I think you're right that there are more YIMBYs. Okay. Any other questions? I don't know if I'm getting all of them. I kind of have to pop around to see. I got a YouTube question, I got a LinkedIn question, I got a TikTok question. I don't know if the Substack questions show up. Sorry, Substack, if you're not showing up for me. But I'll leave it on that note. YIMBYs, keep doing what you're doing. You're helping the economy, you're helping your neighbors. I know you know this. You don't need to hear this from me. But thank you for coming to my live, and I'll be doing this again next week. I actually just got back from New York City. I was on a work trip, and I'm a little tired, so next week will be even better because I won't be as tired. It was fun to go to New York, though. What an urbanist paradise New York is, with the super tall apartment buildings, and you get to ride the subway everywhere. People sometimes get surprised that I ride the subway. Like, you ride the subway? I'm like, it's the middle of the day. Why wouldn't I ride the subway? I never had any issues on it. I know that you hear these horror stories, but it's because so many people ride the subway every day. Of course, one of those people out of the millions of people who ride it are going to have a horror story that makes the local news. I think the subway is great. Maybe I wouldn't take it super late at night. I did when I was younger, though, but maybe not anymore. Anyway, go Knicks. Knicks in 5, right? I was in New York, and I was around so many people in their Knicks outfits, and I was there when they won the game last night. Now I'm like rooting for the Knicks. Why not root for urbanism? Rooting for the Knicks is rooting for urbanism. More so than San Antonio. New York definitely has San Antonio beat by a lot when it comes to urbanist policies. So go Knicks. All right.